Our next topic in this stream is alternative risk premias and why they are the way of the future. Our speakers on this topic are Kamini Naidoo, a portfolio manager in the alternatives investment team at Momentum Investments, and Sudesh Moodley, the head of asset management at Eris Property Group. Alternative assets are such an important theme in how we think about portfolio construction today. First off, Kamini will be having a look at what is included in alternative investments, what's included in the private market space, and of course the very important themes in this asset class of liquidity and how it actually affects further complexities. Sudesh will then give us examples of how this plays out in the unlisted property space. So Kamini, Sudesh, over to you.
In a challenging low-yield environment, investors are seeking to diversify their portfolios and capture other sources of return. Alternative investments offer just that and offer investors numerous benefits. These include improved diversification as a result of low correlations with traditional asset classes, access to a wider menu of investment opportunities, and the potential to generate robust financial and social returns. Today, I will unpack some of the more common alternative risk premia that these investments access and the benefit that these can bring to any investor's portfolio. So what alternative investments offer investors is the ability to access different areas of the capital structure and therefore different return sources than those available via traditional investments. This chart shows the expected risk and reward across the various financial instruments. While the instruments shown in the bottom left of the chart, such as the cash and secured debt instruments, are available to most investors via banks and bond markets, much of the rest of the capital structure, with the exception of ordinary equity, can only be accessed through the alternative investment approaches. Let's look at the alternative funds. Private debt funds specialize in lending activity and raise money from investors to lend to companies to fund ongoing operations or further growth. This lending can be in the form of secured debt, unsecured debt, or mezzanine funding. Mezz funding, which you see in the middle of this capital structure chart, is a hybrid debt and equity financing that gives the lender the right to convert debt into an equity interest in the event the company defaults on its loan. Or it can provide synthetic equity exposure if the company meets performance goals. Private debt investments generate strong returns, but these are medium to long-term investments. So in order to realize the full yield on a private debt investment, the investor needs to hold the investment to maturity. On the contrary to private equity funds, which typically own some or all of a company, private debt generates return from interest in loans. So private debt can also provide the leverage that a private equity investor requires to buy and invest in businesses. Alongside the mezzanine funding, private equity can utilize the various equity instruments to fund growth and turnaround strategies in companies. Moving further along the capital structure, hedge funds have the ability to use gearing on listed equities to maximize return, as well as the ability to generate returns through shorting. So in a low-yield, moderate growth environment, the ability to access returns across the complete capital structure can offer the investor good diversification, as well as to increase the yield of the overall portfolio, and thereby the probability of achieving the objective. Across alternative investments, we distinguish between two families of alternative risk premia. The first being that on traditional financial assets, and this really refers to the long and short risk exposures as used by hedge funds. Hedge funds operate in public markets, but have a wider toolbox such as leverage and short selling, which they then use to extract returns from public market securities. And this is across all asset classes, be it equities, rates, credit, currencies, or commodities. One of the more common trades for hedge funds is the relative value spread trade, where the fund buys an undervalued security, so goes long, and sells a related overvalued security. As the spread normalizes, the fund will generate a profit. So in periods of increased volatility, these dislocations in spreads increase and the funds can generate greater returns, thus being able to access a volatility risk premium. The second family of alternative risk premia is on private markets, such as private equity, private debt, and real assets, which includes infrastructure and direct property. Let's look at these in more detail. The market for private assets is distinct from public markets along many dimensions. Although the underlying economic exposures of private and public investments may be quite similar, Private assets are generally less liquid and more complex when compared with publicly traded stocks and bonds, and give investors access to additional sources of return. As mentioned earlier, both private debt and private equity require that investors remain invested for the term of the funding to earn the promised yield. Real asset investments can take the form of either debt or equity, and the funding is used to fund real assets such as infrastructure or property. While holding illiquid assets means the investor must be willing to forego the ability to dispose of the asset in the shorter term, the additional return that the investor will gain from holding these assets is what we refer to as the liquidity premium. A liquidity premium is applicable across both traditional and alternative investments, as can be seen in this chart. The more liquid securities, such as money market and large cap equity, will yield a lower liquidity premium. There are many factors that determine an asset's liquidity. Some assets, like large cap equities, can be traded within seconds, while corporate bonds may trade twice a year, and the average holding period for institutional property is a decade, if not longer for quality assets. While large cap equities can generate good returns in suitable environments, these are through exploiting a traditional risk premium, such as value or momentum, and not a result of the liquidity premium. The black dots here represent public market assets. Hedge funds plot in the middle of this continuum, as the liquidity of these strategies tend to be a function of the underlying traditional assets in which they invest. The red dots correspond to alternative investments, and it can be seen that these tend to access the less liquid opportunities, but with the ability to generate much higher returns. As the holding period increases, so too does the expected liquidity premium. Accessing and investing in these longer-dated, illiquid instruments is also more complex. So in the same way that investors expect to be rewarded for investing in less liquid assets, investors should also expect to be compensated for investing in more complex transactions. This is termed complexity premium. Across all three strategies, the transactions tend to be more complex than typical public market investments. Transactions can span multiple geographies, currencies, industries, and involve multiple parties. For example, in contrast to traditional listed bonds, private debt is not standardized. Thus, it offers the financing partners involved significantly more flexibility in contract design and can also cater to the individual needs of borrowers and lenders. This leads to higher transaction complexity and interest premiums, and fraud risk is greater as compared to traditional bonds. The trade or investment that can be made by an equity manager, a hedge fund manager, a property investor, or a private equity investor are very different, and each allows the investor exposure to a different value add. The nature of the value add in each of these is therefore very different. In particular, private market investors have an advantage over public market investors in that they typically have a much greater degree of control over the underlying assets. For example, a direct property investor can refurbish or repurpose a property, and a private equity investor may have significant level of influence over the business strategy of companies in which they invest. Amidst an economic downturn in markets globally caused by the COVID-19 pandemic, private markets are well placed to support the economy and generate financial and social returns in a stressed environment. Given each private transaction is structured for a specific circumstance, they can be manufactured to limit downside risk or insulate cash flows from exposure to specific market stress. Moreover, there are certain asset classes which are inherently less correlated to market factors, for example, solar projects or toll roads. Sudesh will take you through an example of a sustainable project in the direct property area that generates both the financial and social returns investors are looking for. Thank you.
Just a reminder, if you have any questions, you can drop a question in the chat box and we'll answer it during the presentation. My name is Sudesh, and my presentation today provides a practical example of achieving a premium return within direct property, consistent with Momentum's sustainable goal of providing affordable and clean energy. The presentation first illustrates the current global and local status of renewable energy with efforts to increase the generation in the short to medium term. It further expands on the average build time and costs for the various renewable energy sources, of which solar is the preferred choice. The presentation concludes with the financial merits of solar, including the benefit of a reduced carbon footprint and the creation of jobs from within the local communities. If we analyze the global energy production, renewable energy is currently the world's preferred resource in generating electricity. The demand for renewable energy is expected to increase further, with close to 60% consumption predicted by the year 2040. Coal's share of the global power supply is set to fall to 28% in 2030 from 37% in 2019. By 2040, the fuel that once was the staple of utilities is expected to fall below 20% for the first time since the Industrial Revolution. Cheaper costs associated with renewable energy, along with government's efforts to reduce carbon emissions, will ensure that most of the future power generations will be in the form of renewable energy. So how does the global energy production translate to South Africa? South Africa has its challenges in providing reliable and sufficient electricity to all of its citizens. However, the government is committed to invest into the grid and is close to amending regulations, thus allowing the private sector to supply power into the grid. Municipalities are now being able to legally procure their own procurement power, which is an indication of government's intention of bolstering the economy by providing more reliable, affordable, clean energy at reasonable pricing. The current energy production in South Africa is in the region of 44,000 megawatts, with coal being the largest contributor at 37,000 megawatts, followed by nuclear, gas-fired stations, and finally hydro stations. The CEO of Eskom has recently advised of 16,000 megawatts of additional power, which is required by the year 2030 in order to maintain a stable grid. The additional power is due to a combination of power plant retirements, maintenance, and economic growth expected over the next 10 years. This will create opportunities for renewable energy production, with solar being the preferred choice after considering the average build time, which is favorably positioned when compared to the alternatives like wind, coal, and nuclear. The average build time for solar is between 18 to 24 months and is the shortest period when compared to wind, coal, and nuclear, and is also the cheapest amongst these other production methods of electricity. The current solar plants adopt an hybrid model, which generates and uses 1 megawatt of electricity with the balance procured from the grid. With the expected amendment in regulations and more affordable battery storage, solar plants would be able to supply 100% of the specific site's usage requirements and have the ability to generate and store excess electricity that can be fed back into the grid. Based on current legislation, the solar plant's generating capacity is limited to 1 megawatt of power. Whilst NERSA is now able to issue generation licenses above 1 megawatt with minister approval, the generation license process is still a very lengthy one. Our existing solar plants have been constructed in a modular fashion to allow each solar plant to expand further when the necessary approvals are in place. Considerations will also need to be given to the roof area available, including the size and its structural condition. On average, a shopping center of around 17,000 square meters will be able to support the construction of a 1 megawatt solar plant, providing the roof area is structurally sound. The financial benefits of a solar plant, as illustrated in the table, is based on an actual case study on the implementation of solar at 7 sites within the Momentum Direct Property portfolio. For an initial investment of 9.3 million, the model is expected to achieve a 42% return of investment in year 1 and a 38% internal rate of return over the next 25 years. This excessive internal rate of return, coupled with a short payback period, is a result of a lower cost of energy generation when compared to the higher Eskom tariffs. South Africans can expect a 15% increase in the electricity costs from mid-2021, which will mark a decade of average annual increases of 14% relative to the average inflation of 6%. The assumptions used in the solar model are quite conservative when we consider the projected double-digit annual increases which we can expect from Eskom in the foreseeable future. The benefit of these savings is for the buildings, some of which can be passed on to tenants to provide affordable energy to communities where momentum have a presence. Solar also provides further tax allowance incentives, including a reduction in a carbon tax payable. In addition to improving security of electricity supply, solar would boost the fight against climate change by utilizing power that does not result in the emission of greenhouse gases. South Africa produces the same quantity of greenhouse gases as in the United Kingdom, whose economy is 8 times larger than ours. Eskom, which runs a fleet of coal-fired power stations, is the country's worst polluter and accounts for 40% of the greenhouse gas emissions. In comparison, solar is a clean, renewable source of energy that can help reduce carbon dioxide emissions and lower our impact on the natural environment. Unlike traditional natural resources like coal and oil, solar energy does not lead directly to pollutants being released into the atmosphere and water supply. A solar plant of 1 megawatt will reduce in excess of 1,600 tons of carbon dioxide, equivalent to the power required for 300 households. The lifetime of a solar plant is in excess of 30 years, with the solar plant at 25 years still providing 86% of the power first generated in year 1. We have already identified other sites to implement solar, where the benefits extend even further to provide an affordable and clean energy. These solar projects will create short-term employment in the local communities during the construction phase, which will extend to permanent employment post-construction. Training programs are also carried out to upskill and grow these members living in our local communities. In conclusion, alternative premium can be found in even the most unexpected areas like direct property. There's always premium to be found for the active investment manager, identifying value for the discerning investor. Thank you.